Hi, this is Jim Cramer, founder of The Street. Every day you hear me talk about individual stocks in the markets, but there's another important area of trading opportunity that I don't talk about enough. It's futures. Together with our friends at CME Group, what a great stock that is, we have put together a fantastic panel of experts to tell you everything you need to know about how to trade futures in the current crazy macro environment. You'll also learn about CME Group's E-mini futures and micro E-minis, which bring the benefits of futures to the average retail trader. I love that. It's democratization. Thanks for watching.
Hello, I'm John Najarian, and thank you for joining Trader Talk. Today I have Jeff Kilberg, founder and CEO of KKM Financial, as well as Scott Bauer, CEO of Prosper Trading Academy, joining me to discuss equity trading. Guys, welcome. It's been a heck of a year. I mean, where could we start? We could start in January. What about that, Scotty? Start in January. All of a sudden, we're coming down from a 3% 10-year to all of a sudden the Fed chairman decides we're going to start cutting instead of tightening. Tell me your thoughts about that.
Yeah, and didn't stop for most of the year. But what we saw last December of 2018, didn't take a lot of people off guard. However, the market obviously wasn't prepared for it. So the big gains that we saw in January when the Fed started changing course here really was coming off the heels of the massive debacle that we saw in the marketplace in December.
That's right. And I think you hit the nail on the head. The expectations when Fed Chairman Powell comes out in December of 2018 in a very hawkish tone and says we're going to have 3 rate hikes, and all of a sudden, 180 degrees later, we have 3 rate cuts in 2019. That's been a very accommodative stance, and equities sure as heck liked it, Doc.
Yeah, they loved it. In fact, they loved it probably too much, Jeff and Scott, because we saw them zoom in January, and then we did what it's boom and bust in some cases, and it's been fits and starts. But nonetheless, the market has been so resilient, and I want to know how much you think that had to do with the interest rates. I mean, when you saw the interest rates coming down as dramatically as they did, to me, that was the biggest sign that we had a long ramp as far as how high we could go.
For sure, and I think the interest rates certainly, that was Fed Chairman Powell maybe getting out in front of the whole U.S.-China trade tariff conversations. But the one of the things we talk about doesn't get enough conversation is the U.S. dollar. Yep. The U.S. dollar really stayed stagnant. That's the one thing that U.S. equity traders really get concerned about is the velocity of the dollar. If that velocity of the dollar moves up to par too quickly, that becomes a headwind. So we didn't see that. And I tip my hat and a little kudos to Fed Chairman Powell. He did a great job of keeping that dollar stagnant in that 97 to 98 range, and that really kept the 10-year under 2%.
Traders that are constantly watching the CME and looking at the futures, whether it's the micros or the full contracts, whether it's NASDAQ or S&P, they're looking and they're saying, wow, when I see the 10-year and the 3-month invert like this, it scares me because, that's what got everybody thinking about right. Recession. And they didn't address it right away in June when that happened, and they let it go almost 60 days before, all of a sudden Powell said July 31st, I think it was, okay, we're cutting again. And that's what finally broke it. That's like the fever breaking. Do you agree?
Yeah, no doubt about it. And I think, if you look at a chart of the S&P during the year here, you're going to see those tops that we saw around the 30 and a quarters level, 30 level. And then it was when they made that cut at the end of July here is when we really started to break out.
That's been the fascinating component because the central bankers globally have really had a coordinated effort. We saw what the Federal Reserve here is doing domestically, ECB, now they just changed the guard, pun intended, to Christina Lagarde. But we'll be interested to see if that dovish stance continues over there because that commitment, that dovish commitment globally, if it's the PBOC, Bank of Japan, whatever it may be, it really has assisted and kind of quelled those fears because there's been a ton of noise in 2019 with the U.S.-China trade tariff conversations. But if you stayed focused on the dollar, stayed focused on where the 10-year is, that has really underscored the fact that it's been risk on.
Well, now, to both of you, what do you think as far as China threw a ton of stimulus at its market?
Yep.
Now, we all know that whether we like it or not, we are globally connected. So when China throws a bunch of stimulus at their market, it's going to eventually work its way over into our markets.
Sure.
And maybe that's some of the inflation the Fed's looking for. Hasn't shown up yet, but nonetheless, they've been super accommodative as far as taking down the required deposits on their banks. They've basically pushed interest rates as far as they can over in China, and they're just flooding their system with liquidity. So do you think that maybe 2020, one of the stories could be, I'll start with Scott, do you think, Scott, that could be one of the catalysts for even more of that hockey stick in 2020?
Absolutely. I mean, I think the recipe is out there for that. And in that accommodation, which, pretty much the rest of the world, like Jeff was talking about, is almost to that point. Mm-hmm. But that accommodation, along with any sort of positivity or resolution with the U.S.-China tariff talks, and I think we are potentially in for a gangbuster first quarter.
Since you have a bullish outlook, give me a bullish trade, if you will. Now, again, this is just an example.
Great example, absolutely. Yes, so, looking at first quarter, again, the key is the U.S.-China tariff talks here. But coming into the year, there's a lot of support. Economically, we're doing just great. Guidance has been lowered already coming into earnings season. We've seen that lowered guidance. So I think it's really not going to take a lot for many of these major companies to beat. So what I'm looking at, and John, back down on the days on the floor, we used to love to put on a trade, real trades back then, but trade example now of what's called a risk reversal.
All right.
And so what I'm looking at in the S&Ps, in the E-minis here, is I'm going out to March options. Okay. And I'm looking to buy the 3,200 call up above and sell the 30-30 put below. Okay, so buy, call, sell, put. The reason I'm choosing those strikes, first off, to the downside, it's because, like I mentioned earlier, that 30-30-ish level that we hit a couple times July and I think September before we broke out, that was resistance. That should technically be some really good support. And if someone's looking to get long in this marketplace, that's a real opportunistic spot. So right. I don't mind buying the upside call and looking for that pop. And if we don't get it, if we get a pullback in the marketplace here down to that 30-30 level, that's an area that I want to get in, that I think is a very, very opportunistic spot to get in. So someone could do that, buying that call, selling that put, basically for zero. There's no cost to do that because the premium of one offsets the premium of the other.
Now, Scott, that's great explanation, trade example for an optimistic view for the S&P 500. And what he described, folks, is basically buying that upside call at the 3,200 strike and paying a premium for that call and then collecting the premium for that downside. Now, there's a couple folks, big folks, that do that all the time. Warren Buffett's one of them. Warren Buffett loves to sell puts as a way to capture premium. So you're capturing that premium from the put, and it offsets the amount that you paid for the call.
Absolutely. And the reason that I selected that again, it's key because if the market does sell off to that 30-30-ish level, that's an area where I want to have exposure to the market.
So this would put you back in.
It puts me back in if it gets down there.
Nice. Jeff, I didn't want to cast you as a bear because I know that you're a very optimistic guy. But as a trade example, if somebody had NASDAQ exposure, so if they had, whether it's FANG, or whether it's just, the tech sector of his S&P 500.
Right. That's right.
How would you express, maybe a way to protect some of that?
Well, I think two things. First and foremost, I want to be on your jet next year in 2020.
Done.
But secondly, if you look at the FANG stocks, the Facebook up over 50%, Apple up over 70%. A lot of these names have had sensational years. So when I talk about risk mitigation, that doesn't put me in the bear camp per se, but the risk mitigation trade example I want to utilize is looking at the E-mini NASDAQ 100. I want to be a buyer of a put spread. So I'm actually going to define my costs I'm willing to spend in the event we see the market move lower. And I picked a strike at the 8,000 level. That's the put I'm going to buy. That's 5% lower from the current March futures contract, was trading 84.06 for this specific trade example. But selling the 7,700 put allows me to collect some of that premium you talked about, Doc, offsetting what this debit spread will potentially cost. And if in the event the market goes higher, I've defined it's going to cost an active investor $43 to put this put spread into action. So that's a big difference versus being bearish and potentially selling some type of E-mini NASDAQ future or a micro E-mini future, but this is actually buying a put spread to the downside in the event the party gets a little cold here in January.
Now, similar to what Scott did, you were collecting that premium, like you said, on that 7,700, I think,
that's
strike
right.
Put, and yet you have protection from that 8,000 level on down to there. So you got 300 points where that spread could, go from that $43 you paid for it to $300.
That's right.
Offsetting how much for every one of those that you put on, how much are you protecting of that?
That's a great
portfolio?
question. So any one-lot option that you're utilizing the E-mini NASDAQ 100, it's a multiple of $20, which is the tick size in the futures contract. So you're talking about roughly $168,000 of risk mitigation from a notional perspective. Layman's terms, if you have $168,000 of FANG exposure, you can utilize this put spread to offset 100% of that $168,000 notional. Again, these are round numbers.
Sure. And again, as just trade examples and things, if you had 1,000 shares of Apple, you've got over $200,000 worth of exposure.
Exactly.
So one of those trades that Jeff just described would mitigate some of that. Not all of it, but some of that, because Apple is a huge component of the NASDAQ itself.
And you guys trade a lot of options, right? So this is a way to synthetically book profits. And therefore, there's not immediate tax ramifications by utilizing options on futures, but this is a synthetic way to book profits, right, Scotty?
Like you said, you always want to buy your health insurance, auto insurance at a discount. And this is potentially a way, with the way the market has been trading and volatility really trending down towards lower levels, a way to just protect a portfolio if you're not even so much bearish, but just looking for some protection.
Yeah, I am not a bear. Let's be clear, because all the bears in 2019, they have been skinned and they're laying in front of a fire right now, Doc.
Yeah, that's right. There's other good uses for bearskin rugs, and maybe a rug for here. Guys, great stuff. So folks, we heard a great bullish trade out of Scott Bauer, and we had a great protective trade as an example only out of Jeff Kilberg. Guys, thank you very much. I want to thank Jeff Kilberg and Scott Bauer for joining me here today and providing their expertise on equity trades. Thank you for watching.